Alrighty, welcome to my first monthly recap of 2024. You made it through 1 month, 11 more to go. Huzzah! So, uh, talking about January, very long month, very busy month, and a lot of information is coming out quite literally right now as I'm recording this presentation because the Fed is wrapping up their meeting as I speak. They have a press conference. So lots to get into, very timely. I'm actually been talking about the press conferences they're having quite literally right now. So 2024, Happy New Year, Martin Luther King Jr. Day as well. For the love of all that is holy, I cannot figure it out why the Super Bowl is the weekend it is. Like if they moved it back one weekend, they could align it with President's Day on Monday. All of a sudden you have a 3-day weekend with Super Bowl Sunday, and like, couldn't they make like significantly more money? People are spending significantly more without having to worry about waking up on a school night. Anyways, I'm sure there's a reason, but I do not know what it is. I know the NFL cares about money. You figure that'd be more money. But anyways, all right. So January. Inflation is slowly trending in the right direction. It's starting to slow down how quick it's decreasing. I'm going to be talking about that. GDP, I don't usually talk about gross domestic product, but I need to here. And there's a couple reasons why, which you'll see in a little bit. Real estate values, we're grabbing some headlines this week. Talk about that. Mixed signals on the employment report. Some good news, some not so good news. Going to be very interesting report that we get on Friday as well. And then the Fed wrapped up their meeting. Talk about that extensively. And then mortgage rates as a whole. They started the month around 6.5%. They finished around 6.5%. Moved in between, but honestly pretty stable throughout the month of January. That's for a first-time home buyer making less than 120% of the area median income, good credit, all that. But yeah, rates were very stable throughout the month. So let's get into all of this. So starting with inflation. I know. Nobody likes inflation numbers except for Aaron James Staufer. It's like if I was ever going to get a tattoo, it might be personal consumption expenditures or something. So I know inflation is not sexy. It's not fun, but it is relevant. It is important, especially because it's going to dictate what the Fed does and when. So there's 3 different metrics, as you all know from listening to me time and time again. Now, the metric that we got the most improvement on was PPI. PPI is Producer Price Index. It's wholesale inflation. What are companies paying for goods when they get those raw goods? They then package them up, combine them, and then sell them off to consumers, right? So the idea is PPI could be a leading indicator for consumer price index, personal consumption expenditures. It can lead the way for some of those decreases along the line. We saw the most progress being made there. As companies get charged less for raw goods, they could over time pass that savings along to consumers. Now, one of those requirements would be consumers stop spending money because if they're just going to keep buying at the elevated prices, they're just going to keep capturing those extra margins. If consumers start slowing down, now all of a sudden companies can start to lower the price of their goods, still make a fair amount of profit, and then pass that savings along. So it may or may not be a leading indicator. There's a couple things that are at play there. But PPI decreased to 1%. Their core rate, which is when you remove volatile food and energy components, gasoline prices can spike, food prices can spike depending on a number of different things. Take those volatile components out. What's the core rate? The Fed ultimately cares much more about core rates than the headline figure. Okay, Consumer Price Index, that actually increased slightly to 3.4%. Not great. The core rate, good news, decreased slightly to 3.9%. Still a ways to go before it's going to reach the Fed's target of 2%. But ultimately, the Fed cares about personal consumption expenditures. That is the one inflation figure. If they could only have one inflation figure, it would be personal consumption expenditures that they would hang their hat on. So the headline figure came in at 2.6% year over year, very stable. The core rate, again, volatile food and energy removed, decreased from 3% to 2.93. If you took the last 6 months and you extrapolated that out over 12 months, so you annualized 6 months over 12, the inflation figure, core PCE figure, would be 1.85%. So below the Fed's target of 2%. Great news. And if you took the last 8 months and extrapolated over 12, it'd be 2.08. So right in line with the Fed's target. So that's telling you what we really need is more of the same and more time. If we have more of the same and more time, we're going to hit the Fed's target. And the Fed did talk about that today in their press conference. Like I said, they're having quite literally right now as I'm recording this. They said, hey, look, we're making good progress there. We're not out of the woods just yet, but we're making good progress. And they can afford to be a little bit patient. And they can afford to be a little bit patient because GDP, gross domestic product, right? It is the measurement. It's kind of like Moneyball, right? So in Moneyball, they're trying to figure out, get it down to one number so they can compare all these different players with each other. Just get it down to on base percentage. If we can just figure out that, Everything else will take care of itself. Just take care of that. Moneyball, GDP. If they could only care about one number, it would be GDP. And then it's flawed. And there's a lot of different ways you can measure it. But basically, it's the goods and services that a country is producing. Lamest terms for sure, but that's basically it. And if it's a positive number, it's increasing. If it's a negative number, it's decreasing, right? So quarter 3, 2023 GDP. So quarter 3 of last year, GDP came in at 4.9%, like crazy, mind-blowing, blistering pace. Very, very strong. Everybody thought after that, and then I mentioned it last month as well as the month before, I think, that if you looked at the most recent graphs of like consumer debt, it was like all-time highs. And if you looked at consumers' savings rate, it's like all-time lows. So savings rate is low, debt really high. Everybody thought quarter 4 GDP was going to be a soft number. Like something's got to break. Eventually, people have to stop spending money. The cost of goods is too low. People are saving way too little. Like something's got to break. Maybe a very slow holiday spending season. Quarter 4 2023 GDP came in at 3.3%. Expectations were only for 2%. Crazy strong number. What we're finding, no surprise, I guess, knowing what we know, is that Americans are a resilient bunch. That's really what it is. Instead of like cutting our spending and starting to save more money, no, we're just changing our work habits. There's a lot of cases of people in households where they weren't working, going back to work, maybe getting a second job, maybe an unemployed spouse going and finding part-time work or working more hours as a whole. Like we've just found out ways to like keep up our spending habits. Maybe working more, maybe earning more, but keeping our spending habits intact. So not curtailing our spending the same amount, if not more, but just kind of changing our lives around it. It's very interesting stuff. A number of experts are still predicting a recession in 2024. A recession would be 2 consecutive quarters of negative GDP. That's the most basic definition of a recession. 2 consecutive quarters of negative GDP. The experts are starting to move their goalposts back. They're saying, oh, we thought we were going to start to see one possibly happen in 2023, like maybe quarter 4, maybe the spending's really low. Maybe that's the first quarter of negative GDP. Maybe we missed to the downside. Didn't happen. So now they're saying, maybe it's quarter 1, quarter 2. Now they're actually starting to say, hey, given the strength of quarter 4, 2023, maybe it's quarter 2, quarter 3 of 2024. But those experts that are thinking we're going to have a recession keep moving those goalposts further and further back because the numbers just keep coming in kind of staggeringly high. It's pretty impressive to see. Like I said, Americans are a resilient bunch. It also increases the likelihood of a soft landing. Soft landing would be the Fed has all these hikes, is combating inflation, and if they can hike all the rate all these times and still avoid a recession, that would be a soft landing. It's certainly increasing the likelihood of a soft landing occurring. The Fed was feeling themselves a little bit today. They were feeling a little bit of swagger in their step, and somebody asked them the question like, "Hey, how you guys feeling about a soft landing?" And they basically responded with, we're not out of the woods yet. There's still more work to be done. Giving themselves the leeway, which the Fed always wants. They live in that gray area. But you could tell they were feeling like a little bit more confident. Like it's certainly more likely, given the strength of quarter 4, it's certainly more likely that we're going to have a soft landing and avoid a recession at the end of the day. And if there is a recession, it's probably going to be a very mild one, given the strength of the numbers that we've been seeing. So interesting stuff. Home prices were grabbing some headlines this week, and I need to point out a couple things. So first, there's a number of different metrics, okay? A number of different metrics you're going to see on the next slide as well. Quite a few of them. The headlines were really around home prices hitting all-time highs, and that might be the case nationally, okay? But we're elevations credit union. We only lend in Colorado. Talking about the Front Range specifically, right? So Case-Shiller is considered the gold standard for home appreciation. They measure all price points. They measure all homes, cash transactions, jumbo transactions, conforming transactions. They measure the whole thing, okay? And they look at a number of different things, but they also will look at the top 20 metro areas. And when they looked at the top 20 metro areas, they saw home prices, and this is through November. So there's going to be some seasonal slowdown, inevitably in December as well. But they noticed from November 2023 through November 2024, November 2022 through November 2023, there we go, Aaron, the prices are up 5.4% year over year. Very, very strong. In Denver Metro specifically, that was up 1.5% year over year. Again, November 2022 through November 2023. So the information is a little bit dated, but still, it's good to know. And of the top 20 metro areas, only one was actually negative, and that was Portland, and that was at minus 0.7% for that same time frame. So that's Case-Shiller. Gold standard, measures all price points. FHFA reported the homes increased in value 0.3% in November and are up 6.6% year over year. Same time frame, November 22 through November 23. It's on pace for a 7% improvement for all of 2023. Now, really important here, FHFA only measures those homes with a conforming loan balance. So it's going to automatically be skewed towards the low to mid price point for homes. It's not going to take into account a lot of jumbo, high priced homes, luxury homes. It's also not going to take into consideration any cash transactions. So since it's slated towards that lower price point, it tends to run a little bit hotter because more people are going to be able to buy those homes, right? It just supply and demand. It's automatically going to attract more demand at those lower price points. Let's see, first-time home buyers, maybe move-up buyers could still certainly be in that level. Divorcees, young professionals, investors, all of those are going to be more attracted to low to mid-price homes. So FHFA, Federal Housing Finance Agency, tends to run a little bit hotter than Case-Shiller, which measures all spectrums versus just, again, the conforming loans, which FHFA does. Now, these are the various different metrics I mentioned. There's Case-Shiller, FHFA, CoreLogic, Black Knight. There's a number of different ones as well. But when these numbers are gold or yellow here, it means they hit all-time high levels. This comes from my friends at MBS Highway. So gold means they hit all-time highs. So across the entire nation, we hit all-time highs. Again, Denver's running lower than that national average, which, given the ramp up we saw post-COVID, isn't that surprising? It would honestly be a little bit concerning if we were still running hot after all that appreciation. It's like, well, where does it stop? So having that appreciation slow down, I'm glad it's positive. Thank all that is holy. But having this slow down a little bit after the crazy years, and remember, we were one of the areas that was leading the country with regards to appreciation post-pandemic. So it's okay. We'll take that. At least it's positive. It's all good. But when you see those headlines, just keep in mind, those are national numbers. The Denver local area is running a little bit behind. So, all right. So jobs figures. I mentioned at the outset that there's a little bit of a mixed bag. So we got JOLTS report on Monday. JOLTS is job openings and labor turnover survey. So it tries to measure help wanted signs across the entire nation. Okay, so job openings in December increased from 8.925 million to 9.026 million. Again, I talked about some possible issues with the JOLTS report. They might be measuring the same job multiple times if they post that same job in different states for remote work positions. So we just have a new kind of economy, a somewhat remote workforce economy or a hybrid model. So it's entirely possible that they post the same job in multiple different states. The Fed actually came out today in some of their prepared comments, and we're a little bit annoyed with a lot of the revisions and statistics that they're receiving from these various different entities because it's hard for them to make decisions when the data keeps changing. And how reliable is the JOLTS report? Honestly, we don't really know right now. Something's probably going to have to change dramatically there. We did receive also the ADP employment report. That came out today, Wednesday, January 31st. It showed only 107,000 jobs being created in January. That was much lower than the expectations of 150,000. So when I mentioned mixed bag, JOLTS report was positive, more job openings, more help wanted signs out there. That's great. But the ADP report came in pretty tame and quite a bit to the downside. One thing that I found really interesting within the report. So ADP does a really good job of measuring how incomes change for job stayers, those who stay on their job, like what's their increase in wages year over year. And then also, what are job changers receiving? So when they change jobs, how much more are they likely to get paid? So job stayers, they saw their income increase 5.2% year over year. That's great. It is slightly down from the previous month. So you're starting to notice incomes starting to slow their pace of growth down. Again, that's not negative. That's not depreciation. That's just the appreciation is slowing. Okay, keep that in mind. Job changers, this is the one that shocked me a little bit. They saw their income increase 7.2% year over year. That's down from 8% in the previous report. So significant downshift there. Again, not negative, but slowing down the pace of wage increases. That's actually good for inflation because if companies have to pay to attract more talent, they tend to have to raise the price of their goods. And when they raise the price of the goods, that's inflationary. So jobs, income, wages actually starting to slow down their pace of growth is actually a good thing for inflation in the long run too. Inflation slowing down is good for mortgage rates. It also means that the Fed can start to cut those rates early to hopefully have that soft landing that they're looking for. So all this stuff is connected. Again, maybe only fascinating if you're a total nerd like I am, but I am. So January Fed meeting wrapped up quite literally today, Wednesday. As predicted, the Fed left rates unchanged. Everybody saw that coming. Everybody expected that. That is exactly what happened. The Fed did say, we're in a position where we can be a little bit patient. We are not in a rush. We are not in a rush to start cutting rates. The Fed's next meeting is not until March. No meeting in February. So they're going to have a glut of additional data before they do meet next time. So that's good news. They're going to continue to be data dependent. Now, the markets are a little spooked right now. And by the markets, I really mean the stock market. The stock market was crossing their fingers on their toes and saying, hopefully the Fed talks about cutting rates in March. Hopefully that they talk about that. Instead, the Fed said, why? Why would we do that? The jobs market is still humming along, according to all the reports we've seen so far, minus ADP from today. GDP was just gangbusters in Q4 of last year. So people are still spending money. Why would we have to worry about cutting the Fed funds rate? Because people are still spending, people are still working. Like, what's our concern here? And the stocks did not like that. So the stock market is down a little bit today because they were really, again, crossing their fingers and toes, hoping that the Fed was going to allude to a Fed rate cut in March. It's looking more and more likely that's probably going to be in the June meeting. So that's what traders are expecting. That's what everybody's expecting so far. Not likely to hike rates any further. In fact, the Fed basically said we're done with that. Next question is, when do they cut rates? Unlikely March, more likely June. That's what most experts are predicting right now based on the most recent Fed comments, quite literally, that came out today. So. All right, looking ahead. BLS jobs report, Bureau of Labor Statistics jobs report comes out on Friday. It'll be interesting to see how that comes in. ADP was soft today. Will BLS follow suit? We've also seen in the past a pretty big divergence between ADP and BLS. So very, very fascinating. My market update that I post every Friday. We'll talk about that for sure. We're going to get some updated inflation data. That's important because that's going to determine if the Fed needs to cut rates sooner rather than later or not. And then politics is going to be front and center. You know me, having watched this, I try to avoid politics as much as I can. I really talk about more of the economic implications of what's going on. But a couple things to point out. So the Fed avoided government shutdowns in January and February. Huzzah, that's great news. They funded it through early March. Not so great news. They just kicked the can. Okay. One piece that was going to become a big linchpin in negotiations is going to be the southern border of the U.S. You already kind of know which political party wants what there, but there's a lot of question of whether or not they can fund the government without some kind of compromise or agreement with regards to border security. So that's going to be top of mind. That's going to be a big negotiation piece. And then the Red Sea crisis. I mean, when I'm recording this video right now, Joe Biden said, "Hey, look, we know what kind of retaliation needs to occur, but nobody else does, apparently." So everybody's just kind of waiting to see how that conflict in the Red Sea evolves, if at all. So that could cause issues with oil prices, inflation, economy. I mean, everything is really kind of impacted with that kind of thing. So a lot of eyes are going to be on that. It's going to be an interesting political month, and it's going to have a lot of economic implications going forward as well. So that is it. Thank you all so much for tuning in. If you have any other questions, please reach out to me. As you can tell, I love this kind of thing. And thank you all for the referrals, the lifeblood of our business. I say it, but I don't say it nearly enough. Thank you. It means the world to me and my team. We really appreciate you all. So thank you all so much. See you next month. Bye.